Hi, and welcome to the second video in the third module of my foundation course for property investors. And we're going to start looking at the financial dynamics of buy-to-let now. And the first dynamic we're going to look at is whether to buy with cash or buy with a loan. Buy-to-let is a mixture of a variety of ingredients, and depending on what your strategy is and your attitude as well, depends on how you mix those ingredients together. I always compare buy-to-let to a fruitcake, and a fruitcake involves mixing and weighing out a number of different ingredients, and depending on how you mix those ingredients together and the weights and measures that you use depends on the result, and no one fruitcake is perfect for somebody else. I, for instance, have a savoury taste, and therefore my perfect fruitcake will be quite dry and savoury. Another person might have a sweet tooth, and therefore look for a sweeter fruitcake than I would like, and therefore their perfect fruitcake would not be perfect for me, and vice versa. So we're going to look at whether you buy with cash or buy with a loan to start with, because that's probably the first decision that you need to take. And when I talk about buy with cash or buy with the loan, I'm meaning you buy a property with cash and do not remortgage it. And I know of some investors, and professional investors at that, who own outright all the properties that they have bought to let, whilst others are very highly geared, have bought with a loan or have remortgaged, and are highly geared even at 80 to 85% or higher than that, given the recent fall in property values. So we're going to look at whether you buy with cash or buy with a loan. And once again, this financial dynamic is covered in one of my blueprints, hence the logo up in the top right-hand corner. So you can test out, by downloading one of these blueprints, the buy with cash or buy with a loan blueprint, you can test out the dynamics of what I'm going to show you in this video. It is the ability to borrow that increases your profit. And in reality, as I've said, buy-to-let should have been launched as borrow-to-let, because it is the ability to borrow that increases the performance of a buy-to-let investment when compared with other investments that you can't borrow to buy. Now I'm going to start off with capital gain purely because it brings in the cost of the property, and then we will look at yield and rent. So in the case of capital gain, if you were to buy a property costing £25,000, and that is possible today, by the way, £25,000 in cash, if the property increased in value by 3% at the end of the first year, that would be an increase of £750, which would give you a return on your cash of 3%, because £750 is 3% of 25,000. Now if you want to do this on your calculator rather than download one of my blueprints, divide £750 by 25,000 and it will give you 3%. On the other hand, you can what's called leverage your cash and buy a property costing £100,000 with a 75% loan to value mortgage. So at 75% loan to value, you can buy a property costing 4 times your deposit. And I'm assuming that you've got £25,000 deposit and you can pay the transaction costs out of other funds. So with a £25,000 cash deposit, you buy your property for £100,000, and at the end of the first year, with the same 3% gain rate, the property will have increased in value by £3,000, which is 3% of £100,000. Now £3,000 is 12% of £100,000. Do the same calculation again. Divide £3,000 by £100,000 and you'll come up with the result 12%. So in the case of capital gain, the loan version, the loan return, is 4 times higher than the returns on cash. And that is huge. Absolutely huge. But now let's look at the case of yield or rent. Starting off with a rent of 8%, which is achievable today, the £25,000 property will give you a rental of £2,000, which is 8% of £25,000. Take off the operating costs, which I've set at 17%, and in the blueprint you can change all these percentages. But take off the operating costs at 17%, reduces your rent by £340. Because you bought the property for cash and are not mortgaging it, you don't have any interest to pay. So your profit is £2,000 less the £340 of operating costs, which you will have to pay whether you mortgage or not. These include letting and management fees, insurance, statutory checks and the like. So your profit is now £1,660, which represents a 6.6% return on your cash of £25,000. Once again, to calculate this return on cash, divide the sum of £1,660 by £25,000. Now let's take a look at what happens in the case of the loan property, the property you bought with a loan of £75,000. The same 8% return gives you a rent of £8,000 on £100,000, because 8% of £100,000 is £8,000. Take off or calculate these same operating costs at the same percentage of 17%, gives you operating costs of £1,360. Interest of 5% on £75,000, which is the amount of the loan you've taken out. Remember, you bought the property or you remortgaged it at 75% of its value, which gives you a loan of £75,000. Results in interest charges of £3,750 a year. Reduce the rent from £8,000 by £1,360 for the operating costs and £3,750 for the interest, leaves you with a profit of £2,890. This profit, by the way, is pre-tax, as is the case with the cash profit. We have not taken into account any tax. This profit of £2,890 is 11.6% return on your cash of £25,000. Remember, this is the cash you invested in the property. This is the deposit monies. So the return on cash if you borrow is nearly double, just short of double, the return on cash if you don't borrow. Hence I say at the bottom of this slide, whether you are investing for yield or gain, always borrow. As I said at the beginning, buy-to-let should have been called borrow-to-let. And if you increase these percentages, if you take the rent up to say 9% or 10%, because you're moving the rent percentage away from the interest rate, which is the highest cost against the rental income, this loan percentage of return on cash will increase. Likewise, if you increase the gain rate above 3%, if you take it to 4% or 5%, the difference between the cash and the loan return on cash will increase. To see the effect of this, download the blueprint for this particular financial dynamic. And that is the purpose of these blueprints, to enable you to test out each of these financial dynamics. Okay, that brings me to the end of this video. I hope you've enjoyed it, and I thank you for watching and listening. And I look forward to seeing you on the next video in this module.